All right, everyone, welcome to an audio-only version of the podcast, Lender Lounge with Kevin Kim, yours truly here. We are live here at NLE, the National Lenders Expo, and I'm here with a good friend, Zack Lofton with Lone Ranger.
Thanks for having me, Kevin.
Man.
First time for everything.
You know, I wanted to do this in your office, but I was so busy in Austin. I came to Austin, and my assistant just jammed my schedule so tight, and we didn't have enough time. But
yeah, we spent about an hour of it at the bar too.
Yeah,
so.
Exactly. I mean, drinks come first, right? And it was a little bit wet, so we couldn't record outdoors. But for our audience out there, this is going to be an audio only, but we're going to make sure we get some nice photos of Zack and his team and all that stuff on here. So look out for that. Now, Zack, thanks for joining the interview. And the podcast is growing, and we love to include people that have awesome stories of growth. So first of all, introduce the company, introduce yourself to our listeners, and let's go from there.
Yeah. Thanks so much, Kevin. Zack Lofton, Lone Ranger Capital. We started, a little bit more than about 4 or 5 years ago. But yeah, I guess before that, lived in the Bay Area, got into banking pretty early, and pretty early with that, realized I did not like traditional banking.
So you were a retail banker?
Yeah, we were doing commercial real estate banking out in San Francisco.
Loan officer?
No, I was an analyst. I was the lowly Excel wizard.
Oh
yeah. So quickly found out I hated that and I didn't want to climb that ladder. So while I was out there, decided to study for my CFA. Ended up getting that, and that opened up a lot more opportunity for me. So from there, really through a friend of a family friend, weird connection, got introduced to a fund that works out of Phoenix, Arizona. And
who has been on the podcast before.
Yeah,
so shout out to Noah.
Worked with Noah for a little while over there, and great time. But after a while, decided that it was time to branch out, time to do something else on my own, and pretty much packed up a truck, moved to Austin. Didn't have a
So wait. So you moved from the Bay, and then you moved to Phoenix.
Exactly, Bay to Phoenix, and then to Austin. And my wife, bless her soul, she.
And you were married the whole time?
No, so my at the time girlfriend in San Francisco, and then we finally ended up getting married when we were in Austin.
Okay.
Yep. So it's been about 3 years now.
Yeah?
Yeah, thank God. Yep. Yeah, we got a little 9-month-old at home too now.
Oh, congratulations. Babies are awesome.
Yeah,
you and I have a lot of conversations about children, so.
I can't help myself.
So wait, let me ask you this. So you started working with another private lending fund.
Yep.
And you chose to now do your own thing in Austin.
Exactly.
Now, why did you do that? What clicked in your head said I gotta do this on my own?
Growing up, father was an entrepreneur. He had a framing company.
Okay.
So they did. You think about a house when you're building a new build. It's the skeleton of the house.
So real estate's in your blood then.
Yeah. So super familiar with real estate. Had the banking side, had the CFA with the numbers side. So. It's kind of the perfect marriage right there.
Right.
So, and I just knew I wanted to go off and do something on my own. And, if I had success, it was, on me and at this point, my team. But in the beginning, it was just me. And if I failed, it was going to be on me too.
And you were young enough. How old were you when this happened?
Oh, God, when I moved out to Austin, I think it was 26.
Wow.
Or 27 maybe.
So new fund manager at 26. You start with the fund right away, out the bat?
You could call it a fund right off the bat. It was a very humble beginnings.
Right.
In the beginning, we had a Regis office that we called our office headquarters because, having an office was a little too expensive.
A desk and a phone, I'm guessing?
Oh, yeah. It was me so the office it was just a mailing address.
Right.
I was working out of the apartment.
Right.
And, humble beginnings there. We got, some friends, family money, enough for a couple of loans there. But it exploded pretty quick, and we delivered on both ends with our borrowers. We did exactly what we said we were going to do.
Right.
We never committed to anything that we didn't do. So we've got an awesome track record there, and word kind of spread like wildfire. Especially out in the Austin area, and I think it doesn't hurt the way we branded ourselves either.
Right.
But on the investor side too, especially early on, it was. 2016, I don't think hard money was as accepted by investors as it is today.
That was like when it started to become much more mainstream.
Exactly.
Right.
That's when you get some of those big players starting to do it. So
Oh yeah, I remember.
People are starting to hear about it. But yeah, the first year, 2 years, I would have driven to someone's house and washed their freaking car for a $50,000 investment.
Right.
And fast forward today, we're, about $140 million fund, and
fantastic.
Really fortunate to have a great, awesome group of investors.
That's one of the craziest stories, right? Because I was talking to you about this earlier, is that I work with a ton of fund managers, and growing a fund from 2016 in 2021 today, and you're at 120 million, that's 5 years. That takes a lot of work. And your team isn't that big. You're what, 7 people?
Yeah, seven, 8, including me.
And are you the principal capital raiser?
Yeah, oh yeah.
Okay.
Yeah, 100%.
So you got a great back office. I met them, great back office. The Lone Ranger team, they're lean and mean, but they do a lot of damage. And I met the team in the office, and you got a great work culture, great work environment. I like that a lot.
Yeah. Our team, I swear to God, it's no bullshit.
So when did you add those people? So when did your team members join you over the years?
Yeah, so Nick is kind of he's like the right hand in the office. Yeah. He was actually the first employee.
So he's your first addition.
Yeah, okay. And kind of the same story with all of our employees. Most of the people that we've hired, they're not super seasoned in hard money. Mm-hmm. They're not, private equity folks or anything like that. They start, filing papers,
so you got to mail room them.
Oh,
right?
Yeah. Doing data entry, things like that, and just working their way up and really learning the business, because, hard money is so unique that it's, you get someone from mortgage lending, you get someone from, wherever. It doesn't 100% fit. So it's
translatable skills.
Yeah, we've had folks who, they just fit the culture, they fit the work ethic, and we'll fill in the blanks from there.
But as a small group, your fund grew relatively fast, though, right?
Very.
So let's talk about the milestones. So you opened up shop in Austin in 2016. When did you hit your first 50 million?
Oh God! So first 50 million, I want to say was, by year 1 we were there. I want to say it was probably year 3 that we hit
so fast
50 million.
That's so fast. That's amazing. And so that's all within your local network in Austin and Phoenix and California, or?
Oh God! At this point, we have. Nick and I made a list the other day, and it was actually when we were working with you guys at Jurassic, making sure to shore up some filings that we needed to get in. We're making a list of all the investors we have states in, and I kid you not, we've got investors in Hawaii, Alaska.
Oh, yeah, I remember the list. Yeah.
New York.
I figured that was
everywhere.
more toward the tail end as you were expanding, but and when you guys were getting off
the
beginning.
Ground. Oh, yeah, good point. So it was, because I've got the network from Arizona. Yeah. Was really right in the CFA circuit pretty hard, going to those events in Texas. So we got quite a few out there. And then, had some connections from California as well from being in banking. Right. But, other than that, it's because we've never marketed the fund. Yeah,
you guys don't have a massive marketing campaign out there.
No, nothing.
Your website's very lean and mean. It's very slim, and you guys don't have the typical, a lot of these funds out there kind of like crowdfunders.
Yeah. Oh, yeah. God, no.
That. Yeah.
We, what we figure, kind of the same attitude we have with the borrowers is, we're actively going to look for stuff and we're going to push for it, but we're going to let our work kind of speak for itself. So, especially with the investors, we got a track record.
Yeah.
And they were doing all the marketing for us. We were getting,
word of mouth.
Yeah, it's like, Joe knows somebody that he golfs with, and he lives in Idaho.
That's the core essence of building a fund. It's that friends and family to start with, and then let the reputation speak for itself.
Exactly.
Because you mentioned your CFA, and that's something that's also very unique. And there's not a lot of private lenders out there where the CEO has a CFA. And for the audience who don't know what a CFA is, please inform us.
Yeah, so CFA, I guess long story short, it's... You think about
Chartered Financial Analyst, right?
Exactly. Chartered Financial Analyst. They do a series of tests. It's usually 3 tests. They try to artificially put the pass rate for each test at about 30-ish%.
Right. It's one of the hardest exams to pass out there. In my world, it's actuary, then CFA, and then maybe, but way down the list is attorney. So it's I respect CFAs a lot.
Oh God, no. It was very difficult, but definitely worth it. And long story short, it's a fancy way to say that you're capable of understanding some high financial concepts and really, at the end of the day, capable of managing people's money.
Right.
To, just be educated with it.
And so that, I'm guessing that has to have helped you out a lot over the years.
I would say so. And because especially, I was pretty young when I started it. So, talking to a lot of these investors, they see some, 20-something-year-old come in. It's like, okay, well, why should I give you a significant portion of my wealth when it looks like, you haven't run a company before, you haven't really done much yet. I mean, this is like 2016 that I'm talking. Now it's much simpler. But at the time, it was, I had to lean on that really heavily to say, look, this is a vetted process to where I can at least lean on some credibility.
Right. Well, let's put your analyst hat on real quick, because what are the key, what I would consider like features of private lending, but also investing in a fund that does private lending that is so attractive?
Yeah, I mean, I would say, the biggest thing is, kind of super high level, it's common sense banking.
Exactly. That's what I always say.
It's
money
common
in,
sense.
Money out.
Yeah,
There's
exactly.
no weird depository things. There's no weird regulatory things. There's money in, money out.
No, and we don't get cute with the loans.
Nope.
We don't do, weird business loans. We do collateralized real estate loans.
Exactly.
And if it's not real estate, we're not touching it.
Right.
Our fund specifically, we do residential. So we'll do single family flips, new construction. We'll do duplex, triplex, things like that. But we don't do big multifamily. We don't do office loans.
Right.
We stick in our lane, and we've gotten pretty damn good at it over the years.
Yeah.
But it's common sense. It's collateralized. It's usually 70.
So the investors really respond to that. The fact that it's
totally
real estate secured, risk adjusted.
Yeah, 70 cents on the dollar loans.
Right.
And it's high yield. But the misconception is, okay, you're doing hard money. You're a payday. You're a payday lender. You're lending to broke people. Not the case at all.
How do you overcome that misconception?
I mean, really, just education. We had especially early on, I vetted so thoroughly by our investors.
I'm sure.
And our investor presentation, our deck.
Which is very slick, by the way.
I appreciate that. Yeah, over time it got significantly better. Kept improving on that, but education was the big thing to say.
Yep.
The reason why these people will pay, approximately 1% a month is because they're not going to have it for a full year. If they have it for a full year, something went wrong. You should be in and out of this. And at the end of the day, when you compare it to equity, when you compare it to some other sources out there, we're actually not that expensive. It sounds really expensive.
Comparatively speaking, it's pretty good. And on the equity side, if you were to fund a property at 100% equity, the returns the cost of capital is insane.
Yeah, your cash on cash return is going to be so skewed. So it's and that's also on the borrower side, we have to educate them on that too, because if you're going to have an equity partner, I can't guarantee, but I'm pretty certain that
it gets
I can make you more money.
A lot more dicey when you have an equity partner and you go 100% LP style on a flip.
Mm-hmm.
Oh no, absolutely not. Yeah. Well, let's talk about the company, because so first of all, you guys have one of the best names in hard money, because everyone has a very formal sounding name, and you chose a little tongue in cheek. You went Lone Ranger, LOAN Ranger, right? Investments.
Yeah. Lone Ranger Capital.
Lone Ranger Capital, right? In, of course, Austin, Texas, right? And I mean, I'm sure your investors ate that up, right? But talk about that real quick, because that's I love those kind of you don't take yourself too seriously kind of approaches to life,
Yeah, and that was when we were starting the fund, it was, or I say we, and it's an old habit from early on. I would say we to make it sound more like it wasn't just me in my apartment for that first year. But yeah, when I was starting the company, thinking about what we wanted to do and how I wanted to brand it.
Yeah.
There's a couple things I thought about, and one of the first ones was, okay, SEO, we're going to have to think about that because we have to attract borrowers.
You're thinking way ahead, by the way.
I'm thinking...
because that's not something most operators think about at the beginning.
Yeah, because, a lot of these generic sounding names and, love all these guys.
They double up.
Yeah.
It's hard to get that Google ad.
Exactly. Yeah. And if you have I'm making up a fake name because I don't want to pick on anybody, but like Eagle Funding.
Yeah.
Those are two really generic words that, SEO is going to be a nightmare for it. So we wanted
the word Pacific is in a lot of funds in California, right? And you have to be very careful how you choose the name because they overlap a lot.
Yeah. So we had to think about that. And then also we wanted to be, I knew we would find, I was a lot more fortunate with the investors than I ever anticipated, but I knew one day the investors wouldn't be a huge concern in terms of capital raising.
Right.
It was really going to be, how do we get the money placed with great borrowers? Because if we don't have great borrowers, it doesn't matter how much investment we have.
So how the borrowers react to the name choice?
So that's exactly, because we want to, and they love it, but we don't want to sound unapproachable. We don't want to sound banky. We want to, I hate to quote we want to be like delightfully tacky.
Exactly.
It's approachable. They know we're a hard money lender, and it's obvious. We're not trying to be something we're not.
No need to be too serious.
No
need to be a stuffed shirt. Right?
Oh God.
Yeah.
And that's one of our, we always, there's a lot of folks in this business. They want to look like a billion-dollar bank. They want to look like a
and that's fine.
hot shot.
That's fine.
We would much rather look like we are so much smaller than we are.
Right.
Because we want to have an intimate relationship with our borrowers.
Right.
We want them to, every borrower to think that they are our best and only borrower.
Right. But what's interesting though is that you guys haven't done that, but you also now achieved a size of the company from an assets under management standpoint, right? That competes with a lot of the larger funds out there in California on the East Coast.
It's nuts.
And you're growing.
Yeah.
Right?
Oh, we're growing every day.
Exactly. So I want to hear more about that whole smaller than we are concept. Because a lot of folks don't know this, but like I visited your guys' office, and I love this about your office.
Yeah.
It's tight. You guys are all in a room together. You're working together. You're sharing information. You're yelling at each other across the room. Everyone knows what everyone else is doing.
Yeah.
Right? You have a little telephone booth. It's real lean and mean. I love that because it creates a lot of collaborative effort, right?
Yeah.
And, did you guys intentionally choose that kind of space?
100%.
Because you could have gone for the high rise.
Big, fancy. Yeah, I mean, so we wanted to fit, kind of with the name, we want to fit a small kind of family feel. And that's, with the borrowers, but also with our team too,
right.
because our culture is, paramount. And that's what's really had us have some just kick-ass talent on our team.
Right.
And, we've taught them through the years, but they're unmatched. They are so awesome at what they do. And I think part of that is having
the culture is that tight-knit atmosphere?
Definitely. It's tight-knit, it's close, it's collaborative, it's and you saw it. People on here can't see it, but
I want to make sure we're gonna get a photo on her. Yeah. Get a photo.
Okay, perfect. Yeah. But it's like bullpen style where you can turn around and you can talk to anybody in the office very easy.
Right.
I'm not sitting away in a corner office overlooking the city. If they want to talk to me, they just speak slightly louder, and I'm going to hear them from their desk.
You were just basically standing and talking with Nick, and he was on his computer. But the cool part is I was able to interface with all of your staff,
exactly,
and appreciate all of them for what they do. But also, I noticed if one person was talking about something, and all of a sudden, I know about that, you can chime in and collaborate.
Exactly, and it's really helped us, and I think that's been huge in our growth because it's there's no silos like you think about. And I remember when I was in San Francisco doing commercial banking.
Yeah.
So siloed, no communication, and
one guy did only one thing.
It kills
there's no
progress.
redundancy. There's no redundancy there.
No.
Right? Once that guy leaves, someone's got to figure out what he did.
Exactly.
For whatever years.
Yeah. And so that's, in our office, everybody knows the whole loan process.
Right.
People can step in. Do they do the whole loan process? No, but you ask anyone on our team.
They've all done it before? So every single one?
They've all done it before. And almost everyone, they've started from the very bottom, worked it up, and we've had awesome success with that. Folks that just might be overlooked by other employers, but they've been so. I can't overstate it. Just so amazing. And
so let's talk about that real quick, because I always ask on the podcast is hiring, right?
Yep.
Hiring is such a big pain point.
So
but it's so important, right? Finding quality staff. So how do you approach hiring? What do you look for? When you're looking, because you have a different approach. A lot of people will look for like a seasoned lateral to work in whatever it is, loan origination or marketing or back office, like someone who's been doing it for 20 years.
Exactly.
But you're starting them at the bottom. You're mailrooming them.
Yeah, and because, for us, those skills are very important.
Yeah.
And all of our employees need to have those skills eventually.
Right.
But if we're going to look at, technical fit versus cultural fit, you can have someone who's technically so sound and can do the job and can just do it amazingly. And, we've had this before. It's not like it's always been perfect.
Of course.
But a bad culture fit, not only will they bring themselves down, but over time, they're going to bring everyone else's ceilings down a little bit because it's
hard to work with them.
It's hard to work with.
So
and then
hard.
Everyone's enthusiasm and, I hate to use this metaphor, but everyone's drinking the Kool-Aid on it.
Yep.
And when everyone is on the same page and everyone is just excited to come to work every day, the productivity goes through the roof, and that's how we can run lean and mean.
So let me ask you this: how do you interview to find that fit? Because it's very hard. You can't just go off of an interview. You kind of have to force like social interaction. see what they like to do for fun? I mean, what do you guys do?
Oh yeah. So I mean, the interview will be. I mean, it'll be a little bit technical. I mean, don't get me wrong. It's not like we're totally looking at their personality, but we're going to do a culture test, culture index. We like that a lot.
Yeah.
That's been super helpful. But we're also just going to sit there, get to know them.
Right.
And when we do an interview, it's not just me and Nick looking, sitting down with one person, making sure they're a fit. They're going to meet the entire team, and the whole team is going to be part of that interview.
And they're going to have to get along with them.
Exactly, because at the end of the day, they're all going to be working with each other.
Yeah.
Not they all, we all are going to be working with each other. So it has to work that way. So we're really going to look at that, and as long as they have the ability to learn these skills, we'll teach you that stuff later on. That's fine. We'll teach you everything else. You need the attitude, you need the ethic, and as long as that's there, we'll be good. And we've had some great success. We've got one employee, Lucille, who started off, and she's kind of branched into a few other employees just through referrals.
Right.
It's like, hey, I know this person from back home, or I know this person.
And they're bringing their friends over.
Yeah, exactly.
And they have a similar ethic.
And it tends to be a similar mold where, similar ethics, similar personality, or just similar sense of humor. Because that's a big part of being in our office.
That's important too, right? Because if one person's like super sensitive about, certain things, and you guys are kind of a jovial group and talk shit.
Oh, yeah.
You can't. You can't. It doesn't work.
Everyone's talking shit all day. And that's, it doesn't go too far, but it's fun and it keeps it.
It has to be.
It keeps
Especially
it
how small you guys are and how lean and mean you guys have been. You cannot. This is a high stress job.
Oh, yeah. I mean, these loans, it's not like you're doing a, 45-day closed mortgage where, in our time, that's the light years.
Oh, yeah.
A lot of these, we'll get the request on Monday and they say, hey, Lucille or Nick or, whoever in our office, we got to fund by Thursday or Friday.
Exactly.
Because we're working with the wholesaler. We're working with, we put on the contract that it was all cash.
Yeah.
So we need to make sure that we can actually close it.
Yeah. So let's talk about the business real quick. So right now, Lone Rangers focus exclusively on resi and a little bit of, you said multifamily, a little bit of it, not a lot.
So we'll go up to like 4 units. We won't do, or like townhouse projects.
Right.
We like townhouses.
Still 1 to 4 then.
But like, in terms of like a apartment building, typically not.
Right. And there's a lot of that in Austin.
There's a ton of that.
And so I've been talking about this with other groups, but Austin is a very unique town in the sense that it's one of the most prized places to move right now.
Yeah.
And so how are you guys dealing with that as a company? I mean, there must be massive cash offers coming in all the time.
It's wild. And that's, it's good and bad.
Right.
Because obviously as a lender, your collateral is worth more and more every day. And shoot, the amount Austin's appreciated is.
Right. Does that raise questions when you're getting a valuation? I mean, that can't be right.
Yeah. We'll see something and we're like, no way. And then, it ends up being accurate or they end up selling for that. And awesome for them. But, it will tend to be, we try not to be too conservative, but, we're a lender. We have to be a bit conservative.
No, I get it. Yeah.
But, throughout the course of the loan, our asset value is getting higher and higher and higher.
Values have increased, 30%, I heard, over the past year or so?
Crazy. And what I love about it, I mean, it's, we've seen stuff in the past where it's, values increasing for no reason, but it's the amount of sheer jobs that have moved to Austin specifically, and, Texas and, as a whole, it's been staggering.
Right.
I mean, between Oracle, Google, Amazon.
Right.
It's
there's
nuts.
there's the Oracle move, the Tesla move. I'm hearing about the Goldman Sachs move to Dallas. There's a lot of wealth coming here. But let me talk about that real quick. So when it comes to the growth of Austin, because Austin's your primary market, right?
Yeah, we're probably right around 50% Austin.
And the remaining 50% all throughout Central Texas or all over Texas? Or
So we'll typically stick to the metro. So we like, the greater Austin metro. We like the, Dallas-Fort Worth metro. We're actually doing quite a bit in San Antonio these days as well.
Yeah.
And then we'll get Houston. Houston's been a tough market for us to penetrate, but we like the Houston market.
Right.
It's just not a huge portion of our portfolio.
Sure. And you've been branching out to like Colorado and Tennessee and other states like nowadays. Starting to your expansion plan now, right?
Yeah. We just got into Tennessee and really pushing Nashville pretty hard right now.
Yeah. Another great place to move, apparently.
Oh God, and it's just again jobs. It's so many jobs coming there, and you're seeing the coast. Everything's kind of moving inward a little bit.
Yep. Well, let's talk about your perspective on the Texas market, because Texas is, especially Austin and Dallas, such a unique market because fix and flip's not really a thing here.
It is, and it's so funny. People think Texas market, and you can't even
No, yeah, it's true.
It's
Austin
like
is
4
so
or 5
different.
different markets.
Even within Austin, you've got pockets that are so different.
Oh yeah, so different. You've got areas where there might be some fix and flip here, or this area. Yeah, you can't make the math work there. It's got to be a teardown.
Right. And it seems to me that in Austin and parts of Dallas that it's more construction that seems to be driving the trend.
We're seeing a lot more construction, and I think speculating a bit here, but you're seeing the margins on the flippers get a little tighter, and part of it's there's so many wholesalers that are tying these up, and obviously they've got to make their premium on it too.
Right.
And then just everyone is getting into the flip game right now. So you're seeing the margins compress a bunch on the flips, and on the new build side, it's
still healthy. Yeah,
it's still pretty healthy, and part of it is being a flipper versus being a builder. Those are two different animals.
Absolutely.
Not diminishing flippers at all, because flippers that's incredibly hard too.
Right.
But the builders, it takes a different set of skills.
Right.
So we're seeing the margins really healthy on that side too, and in a way we people think of the construction as a little bit riskier.
Right.
We almost like it a little bit better because you're starting from literally the ground up.
Right.
And you're going to have to pay for everything. So those budgets from a percentage aspect actually tend to be a little closer to spot on. Whereas the flips,
you can project because you have funds control, you know what's coming.
Exactly.
Yeah.
So we love those.
But when it comes to construction though, it's interesting. I was driving through Austin when I came to visit you guys.
Yeah.
And it's an interesting town from that perspective because you don't see master plans. You see a lot of custom homes, right? And you see a lot of these houses, like you got a beautiful, newly built home, and then right next door, you got a chicken coop. Like literally like barbed wire, aluminum siding. And that's just a fascinating real estate market here.
Yeah, you talk about keep Austin weird. That is...
It's definitely...
That is
but
the definition.
Values are still there, and that's the fascinating part.
And that's where I think we really... And why we've been so successful in Austin is because, a traditional lender, that is really hard to underwrite.
Right.
When you see a chicken coop next to a new build, across the street from a, 1980s build.
Yeah. And then you got down the street, you got like some kind of outdoor restaurant, bar, coffee shop thing going on.
Yeah.
Food trucks down the street there. It's an interesting setup. You don't see that anywhere else in the United States.
And that's why, us having, literal boots on the ground in Austin, I think is so important. I think places like, newer cities where there's a lot of master plan communities, you can get away with doing that remote and, underwriting that remote because it's, all 500 houses were built by the same builder.
Yeah.
There's 3 floor plans.
I didn't see a single Toll Brothers sign when I was driving through Austin. And now I drove north past Cedar Park. I saw one.
Yeah, I was going to say.
I saw one.
Further north there, you'll see it. And that's, those big mass production builders can survive way far up north. But the geography in Austin doesn't really allow for it. It's it's hilly. It's
very hilly.
People think of Texas, they think dry. There's water everywhere in Austin.
Yes.
There's
lakes
creeks,
everywhere.
Springs,
I was flying
lakes.
in, saw lakes everywhere. These ponds and lakes and rivers and creeks. And it was amazing.
So, it creates an awesome opportunity, initially for the flippers because there were these old houses that as people came into town, they needed to be updated because Austin's an old city. It didn't really boom until now, but a lot of the houses that we look at, 1920s build, even earlier, it's not uncommon.
But that aging inventory problem is slowly dwindling.
Yes.
Right. And so now you got an inventory problem, right?
Exactly. Now there's an inventory problem, and you're seeing, and that's where the new builds are kind of coming into play too, because a lot of the low-hanging fruit with the flips, they've been picked.
But there's a lot of folks that say, even in Austin, Texas in general has so much land, right?
Yes.
And so is that still the truth in the Austin metro, Dallas metro? Is there still enough land to build on?
So I would say, Austin and Dallas, 2 totally different stories in my opinion. Austin, it's so hilly. You go west, and it's just so expensive to build because it's hilly. Yeah. It makes it beautiful.
The engineering is a nightmare.
But and then you go east, and you're on clay. The soil's got a bunch of clay underneath. It makes the foundations a nightmare to deal with.
I'm sure, yeah.
And then west, it's all rock. It's all bedrock down there, so it's
more labor.
Really difficult. Yeah, especially if you're dealing with an incline. So from a mass production standpoint, they can't make those numbers pencil out. So it's difficult in terms of really building out in a big way. Mm-hmm. Up north, you can do it a little bit. Dallas,
so it's
I think,
perfect for the spec home builder. And that's great for you.
Yeah, and that's why we exist because those are our clients. That's who we love.
That's awesome.
But Dallas, a little bit more opportunity for that. It's a little bit flatter, a little bit closer to the plains.
Yeah. Dallas is very much like, I got here and I was like, it's very much like, it feels like LA.
Yeah. It feels like LA, kind of almost like Phoenix-esque too.
Yeah. Very corporate, I can see Toll Brothers loving it out here. Right?
Oh yeah. Yeah, a lot of Fortune 500 types up here. And if you're comparing Austin to Dallas, it's like, oh my God, this couldn't be worlds further apart.
Right.
And we lend in both areas, but in terms of needing boots on the ground, we need them in Austin.
Right.
Dallas, we can kind of get away with, send in inspectors, send in, the appraisers to go view them for us.
So let's talk about like the future for you guys. What's the challenge right now for further growth? What's keeping you guys from growing? Is it the market conditions? Is it new markets you don't want to break into just yet? What's keeping you guys from growing even further?
Yeah, I would say right now it's new markets because we
Austin's getting a little crowded, right? Texas is getting a little crowded.
It's getting crowded. Money's coming in here, and it's crazy too. Money has never been easier to raise right now.
It's so commoditized.
It's never been easier to bring on investors.
Let me ask you that. Why do you think that is? Because you're an analyst, you kind of have that brain.
Yeah.
I personally believe it's because investors, even retail investors, they don't trust Wall Street. It's all over the place. They love our market.
Agreed.
Fixed income is dead.
Yeah, because like you said earlier, it's common sense lending.
Yeah.
It is, here's an asset, here's the value. We're going to lend this percentage of the value, and it gets a pretty damn good return on it too. So, yeah, you look at Wall Street, you look at, a stock, it goes up this amount today, it goes down, an equal amount tomorrow.
Like last night. It was just
exactly.
like, what? Yeah.
Yeah, you get inflation fears, and it goes, it tanks 2%, and then today I think up about 1.5%, and there's for most people you can't rationalize that, and
it's mind-boggling.
Yeah, even with the CFA, I've studied that for way too many hours. I can't rationalize it most of the time.
No, but this makes sense.
Yeah,
but there is the concern nowadays with real estate values being so inflated, especially in these new metro. You guys are Texas is the darling state. Texas, Arizona, Idaho, Florida, the Carolinas, Tennessee are now the darling state. Everyone wants to live there now.
Yeah,
even I want to move there. But but that is inflating values, don't you think? I mean, that's what I worry about.
Oh, totally. It's definitely inflating values, and it's something that we watch a lot.
So what are you doing to mitigate that risk in the long run?
In the long run, that's where we're getting into other markets too.
Okay.
Like, you look at Tennessee because, and we love Austin. We think Austin's got a lot more room to go. I think it's been a little too affordable, and it's, starting to get to where it probably should be.
Right.
But to mitigate that, we're going to places like, Nashville, Tennessee, where the median home price is like almost smack dab right at the national average.
But but they're not seeing as much over inflation in values yet.
Not yet.
Okay.
I mean, they're definitely seeing it, but it's not.
Because where I'm in California, it's been like that for the past 5 years. It's insane.
Nuts.
Like, a house can sell in 3 days, all cash offer for $150,000 over asking price.
Yeah.
It's insane right now.
Yeah, and that's where, we obviously want a great market. We don't want too great of a market.
Exactly.
And that's where it's just really, we've got to, we love funding deals. We love doing stuff for our great borrowers, but we've got to, at the end of the day, we're money managers. So our investors always come first.
Right.
So that's where, we stick to our underwriting criteria to where, we're not going to lend to questionable people with questionable experience. We're going to lend to only the our great borrowers, and we're going to lend at usually 70% loan to value. So then,
you've been, and I know you guys have been sticking to those guns for a long time.
Oh yeah, and that's
you're not chasing that, right?
Since the beginning, and that's why we've expanded as opposed to really doubling down in Texas and saying, "Oh my God, we're going to take all the market share."
Right.
Some of the market share we don't want,
right?
Because it's too risky or it's too high in the leverage, or they're just dropping the rates to where we don't think it's in the best interests of our investors.
And as a fiduciary, as a money manager, you have to keep that in mind.
Oh, yeah.
It's so scary. It's so easy to fall into that trap. Oh,
so
70,
easy.
75, 85.
Yeah. Where do you draw the line?
Exactly.
Because if you don't draw one, then it creeps up forever.
Oh, yeah. So let's talk about that, though. Beyond that now. So we're talking about new markets. What's beyond expanding to new markets? What else is in the cards for Lone Ranger? What else do you guys want to be working on in the next few years? What are you excited about?
Yeah, I mean, the biggest one, and we've been working with you guys, is the new markets. So obviously that, we talked about that. we're getting a little.
What else? Colorado, Tennessee, anywhere else?
So we like those markets. Carolinas are great.
Okay.
I love Florida, but just kind of like Texas, all the money is going to Florida. Yeah, so it's it's interesting. I think the Southeast over the next decade is going to be really well poised to have a strong market.
Oh yeah, I agree.
It's and you saw it with all the COVID stuff. It was they did a little bit better economically.
Oh yeah, no lockdowns.
Yeah, exactly. And however you feel about that is how you feel about it. But from a business standpoint, it really
their economies
in
didn't
other
suffer
places
as hard as California or other states.
Crippled businesses, and they let a lot more of them stay open, which was great. The construction crews, the Northeast. I hear horror stories from lenders I know. They weren't able to do any. They weren't able to pull permits.
They were stopped. They stopped building. We were lucky in California. They allowed builders to get back to work, but that was after it took about a week and a half.
That's gonna be a scary week and a half.
Yeah, it was.
Especially a lot of
construction lenders.
Yeah, the lenders and the borrowers is like, I don't blame them. I wouldn't want to pay interest if I wasn't able to work on my project.
Right.
So that's tough.
I love that, man. I mean, you have a very clear expansion plan. How about when it comes to I guess the fund? I mean, what's the vision for the fund? Keep going, just keep on raising money, grow as big as we can.
Yeah, and the fund is difficult because there's so many opportunities nowadays with how you
get deals done. Yeah, Wall Street's all over the place now.
Oh my God, yeah, Wall Street's all over. I mean, note buyers are everywhere. It's never been easier to sell notes, which.
Let me ask you about it. I mean, you've been approached, I'm sure, to sell loans, but you haven't recently. I mean,
multiple times a week.
Yeah, and so how did you say? I mean, how do you stay disciplined? Say no to that. I mean,
yeah, I mean, and it's really easy to do it, and. The reason we didn't do it because it's very tempting because the rates that they're going to buy them at are
great,
really great rates. It's pretty low. We can make a nice spread on it. So from a pure economic standpoint, and our bottom line, we should be doing that. We should be doing a lot of that. But then the reason we don't is kind of tying it all back to culture and taking care of our investors, taking care of our borrowers. For our culture, we're not going to be able to be as quick. We're going to be beholden to Wall Street, especially on, you think about draw requests for, you build a house, you're doing a flip, you put the floors down, we can do common sense. We get our inspector out there, or we get a team member out there ASAP.
Not as efficient.
We can get a draw done in 24 hours.
If you got another overlord or you're holding somebody else.
Yeah, it'll take 2 weeks.
Much different.
I mean, that's pretty average.
And that's fantastic for a lot of operators, but I feel like fund managers especially, you need that unique twist that you have built over the years,
and I think that's what and one of our values in the office is it's on the wall. It's value beyond the rate. So we're not going to be the cheapest.
Yeah.
But at the end of the day, we will make our borrowers' lives the easiest.
Right. Through service.
Yeah, through awesome service, through speed, reliability.
Right.
You saw a lot of lenders through COVID. They pulled the rug out from under their borrowers and they called notes or they stopped doing draws for whatever reason.
Right.
That's not us. And you think about our investors too, starting from, literally nothing, where we're in an amazing situation today. To me, it feels selfish to take that deal flow away from our investors and then give it to, an insurance company or a big note buyer or someone like that.
Fantastic. Well, I can appreciate that as well because my advice to fund managers has always been it's okay to do it, but you've always got to have your own balance sheet because you never know. COVID was a good example. You never know, and you need that backup plan.
Yeah, and Wall Street can be very fickle. What's hot today may not be hot tomorrow.
And I have a very long memory, and I started in this industry right after '08, and I was in law school during the recession. I remember exactly what happened, and all you need to do is think back to COVID to see. It's okay. I mean, I love those guys, and I wish them the best, and I recommend them to a lot of my clients.
Yeah.
But it's a tool in the toolkit, and that's what it should be, right?
Exactly.
Yeah. Let's talk about Zack now. I want to get to know Zack a little more. Our audience get to know you because I honestly, there are a lot of clients that I work with, and I really like hanging out with. I really enjoyed hanging out with you. We've had a lot of great talks. You're living in Austin right now. You're living downtown.
Yeah, more or less downtown East Austin.
Nice. And you've got a little one, 9 months old?
9 months old, yeah. She is, oh my God, so much fun right now. I'm not going to say it was easy.
Right.
But
and 9
she
months,
is so much fun.
They're starting to sleep better. They're starting to eat better.
Yeah. Full night of sleep will do a lot for you.
Oh yeah, I'm currently fighting a 6-month-old, so she's not sleeping at all. So it's fun, but yeah,
man, it gets better.
I'm sure it does. And it was funny because she was out like a light at 6 months, but it's okay. They're all different.
Yep. Yeah, we'll get less lucky on the second one.
Yeah. I mean, but let me ask you this: so, having kids, through this past year with COVID, you had the baby during COVID, basically, right?
Yeah.
I had a baby during COVID, right? And so they're not that far apart. And, we're all kind of closer to family, right? And so I want to hear about your thoughts on your experience having a new father during COVID. How was that?
Oh my gosh. I mean, to say it wasn't stressful, you'd be lying because it was, you think back to March, everything happens like, okay, 2 weeks, we're going to be good. Perfect. We'll bunker down for 2 weeks. We're good. And it keeps going and going. And then our investors get a little worried because you don't know if people are never going to leave their houses again, go out to a showing, nobody's ever going to sell their house and buy their house again. It was, doomsday stuff. So, luckily we've got some amazing investors to where, and it took me a long time, but eventually talked to every single one on the phone and just explained what our stance was.
That's a big thing. That's a big deal right there.
Those were, the first few at least were really hard conversations to have.
Oh, I'm sure.
And because
freaking out.
People are stressed out and, a very emotional time, but we're able to, get them all,
So you calmed your investors down.
Calm down, get them relaxed on our side. So dealing with that, and then at the time my wife was, I think in March she would wish I was better at math here, but about 5 months pregnant.
Yeah,
so that's just stressful at that time. You really want to enjoy that time and love it, cherish it,
but you're also freaking out because of work.
Yeah, because we don't know if people are going to buy and sell houses.
I was in that exact same position. I was calling all my clients. I think I called you, and my wife was 6 months pregnant. I'm like, oh, crap, what's going on here? And I also got a 3-year-old who's like just climbing all over the place.
Yeah.
It was nuts. It was a lot of nuts.
Oh, man. But
were you working from home at the time?
So for a little while, yes. And then, kind of fun. We were talking about it earlier. We worked from home for a little bit just because we didn't know what to do. But the first people to reach out to me to say we need to get back in the office were the moms on our team.
Yep.
They were, and me too, love my wife to death, but between everything at home and 2 massive dogs, it is hard to get work done.
It's a lot. Yeah.
But they said, Zach, we got to get back in the office.
They noticed. They're probably noticing it. I can't execute to the level I'm used to doing it, and I'm letting my team members down.
It's tough to have culture via Zoom.
Oh, absolutely. Absolutely.
You can do it for a little bit, but
I don't think you really can.
I don't think you can have a Zoom culture.
It's not possible.
No.
I really don't. Especially when you're a tight-knit group like that, you can't.
Exactly. Yeah. And just people in general, not even, working. People need to see people to get
human
motivated, inspired, to, kind of let go a little bit.
People love to collaborate.
Exactly.
It's in our nature,
And that's what makes us great in the office is that, we don't have offices for everybody, and, myself included, because I want to be approachable. I want, as things are happening, we're all collaborating. The process gets better all the time. And if everyone's on Zoom, you get siloed. Whether you want to or not, you get siloed.
I remember the feeling. I still kind of feel that way. Now that we're back out there at conferences, I feel a lot better about it. But for a long time, I literally wake up, walk upstairs, go to work, walk downstairs for lunch, back upstairs to work. The only person I see is my wife and my baby. Yeah. It's not the same. It's not.
And the fact that we're at a conference right now, I mean, great.
Awesome.
I mean, it feels great.
It's awesome.
We're out here. We're seeing everyone in the industry again.
We're all back. It's awesome.
Yeah.
So let's close with. I usually have to close with kind of some crystal ball statements and thoughts, right? So where we're headed as an industry. I like the fact that you have a CFA and you're kind of like, I joke about this, but we call you as a garage band fund, nice little team, short,
no, we 100%
lean
are.
team. I love that. But you have a really strong insight into the market that you're going into. So the next year, maybe the year after that, what are your thoughts? Where are we headed?
And you're saying private lending in general?
I mean, private lending, residential, real estate.
Yeah.
And fix and flip, construction, DSCR. I mean, you guys don't do DSCR, but
no, we don't. But I think that's I think DSCR is going to be a big part of our future. As soon as we find a great way to do it, that's just the only thing holding us back.
Yeah.
I think DSCR, and everyone listening is rental loans essentially is what that is. But I think Austin specifically, I think we still have a lot of growth to go. I worry a little bit for the coasts.
Yeah.
Because I just don't see. You see the job numbers
not
moving
that good.
out, with like hordes, and you got the census data that came out, but
California lost a congressional seat.
Which is why, that hasn't happened since, I don't think ever, right?
I call it the Great Migration. It's real.
No,
and it's still going on to this day.
Yeah, because that data was pulled, in March, and how accurate that is with people who were just recently
literally
moved, didn't go to the DMV yet.
Lines of U-Haul trucks leaving California. It's real. Yeah.
So I think people are going to realize that the coast got hit worse than they actually appeared to, and I think that's really going to help kind of areas like, the South, Southeast especially, or even like middle, like, Arizona, Colorado. I think those states are going to benefit quite a bit.
Sunbelt's booming.
God, Idaho.
Yeah.
So I think those areas have a lot of growth to go. Flips, I think, are just getting harder to come by, especially as, it's a bona fide market now. You told people you were a flipper 15 years ago.
Yeah.
That's cute. You're a handyman?
Yeah, exactly.
Cool.
Yeah.
Now it's a career path.
Yeah.
And that's, all of our borrowers, that's their full-time gig is they don't have a day job. They flip homes or they build houses. So I think we got some good growth to go there. The only thing that really worries me is the inflation right now.
Yep.
It's if we can't find a way to curb that, it's a little scary.
And that affects everything. Construction costs, labor costs, fuel costs.
And selfishly, it props up the real estate market, but do you really want that? Yeah, it's artificial. Yeah, you print a few $1 trillion, and oh my God, prices went up.
Exactly. Yeah, when fuel costs go up and labor costs goes up and lumber costs goes up, then the price goes up.
Gets
the
passed
new home
on.
Gets passed through. But when you're trying to sell it in a couple of years, is that going to be sustainable?
Exactly.
I don't know either. I really hope it's not as bad as it seems right now.
Yeah,
but,
especially this month. It doesn't...
it's a little freak out-y, right? With the whole oil thing and the whole the consumer price index came out yesterday. Everyone this week are like, oh, what's going on?
Yeah.
Yeah.
Yeah, so really, I think especially geographically, I love where we're at. I love the direction it's going. But, macroeconomic, it's, if we can't get this inflation under control, it's going to pass on to consumers. But
that usually leads to an increase in Fed rate. Right, which translates to a conversation at Wall Street. Are they going to stay in?
I can't see them staying in. And it's not if, it's when. Because the rate has to go up.
Margins are going to shrink.
Yeah, exactly. You can't have like a Japan-style economy where you've got negative interest rates.
You can't.
We saw how that panned out.
Europe, Japan. It's creeping.
Never historically worked. So the rates will increase, and whenever it does, when they do, we talked about Wall Street being a little fickle. I think those, insurance companies, the big family offices, I think they pull out of the lending space because it's...
Margin's not there anymore.
It's not there anymore. It's just not as attractive anymore. There's better places to park your
most
capital.
likely long equities are probably going to be the alternative. That's usually the play.
Exactly.
We'll see. I'm looking forward to I joke about this, but like private lending becoming private again. Right?
Yeah, and that's what'll happen.
A little bit of a correction. I think the frothiness right now is definitely very foamy. But it's companies like yours and your colleagues out here in Texas and your competitors across the country that are the backbone of this industry. And I think for you guys though, there's not that much concern, right? More opportunity for you.
And that's we talked about selling notes, being involved with Wall Street.
Yeah.
We can make more money today dealing with Wall Street as opposed to our investors, but when they pull out, they're not going to give us a 6-month warning. They're gonna pull out and they're gonna say, "Hey, checks due."
Yeah, exactly.
So by having our investors who stayed loyal to us, we're really well poised when the market changes.
Yeah.
The private money market, that is.
And that rings true across. Past, I guess we'd say 15. I've interviewed a lot of fund managers that have had their funds since pre-2012, pre-Dodd-Frank, came out of the recession, built their fund, and have rid this wave. But they hit COVID and they did better than ever.
Oh yeah. And we're definitely in that boat. We've COVID the first month, 2 months, it was a little scary, and then month 3,
awesome, right?
We said, "Oh my God,
I remember we having that call with you.
This is the best thing that's ever happened to us."
Exactly.
And then with you guys, when that happens, you're going to be busy turning all these note-selling funds into private funds with all their docs.
I tell everyone about this. Like last year, we had a record year because it was a shift in attitude, went back to being kind of more private, retail investor focused. and I hope that the lesson rings true. Keeping Wall Street as a tool is important. It's very important. Make your money.
So important.
Important. No more important than. I mean, it's so important. Make your money, but remember in the back of your mind, keep your memory long and have your own toolkit available to you.
Exactly. Yeah. I mean,
well, listen, you know what? This has been a really fun interview, and we're here at NLE again, once again, national lending experts, right?
Yeah,
leverage,
tongue twister.
But I came to visit you guys here in Texas, and I've loved every moment of it.
Yeah, it was a pleasure having you out. You got to come out again.
I will be here.
I mean, we love working with you, Tay, the whole team.
Thank you so much. And Tay is the actual mastermind behind all. That guy is. Shout out to Tay Kim. That guy works his ass off.
Yeah.
He's working his ass off right now, actually.
Yeah, poor guy.
Yeah.
I wished we started using you guys earlier. I mean, it would have been a huge help the first few years, but luckily the last about 3 years we've been working with y'all, and it's, oh my God, we don't have to, you guys are the experts of that.
And you know what? It's also been refreshing working with you guys because you guys appreciate culture and value counsel, and it's great to have clients like you, and we really appreciate working with you guys as well. So hopefully come back out here and throw a nice big party for y'all and do a big. Maybe we'll go out and do a little bit of fishing and a little bit of hunting, a little bit of grilling.
Yeah, show you kind of that Texas side of the culture.
Exactly. I missed that. I basically spent my entire time in cities this time, so it's okay. Man. Next time.
Yeah, we'll get you out in the country, out on the ranch. And
yes, for sure. Well, this has been a great episode here at National Lending Experts. This is Kevin Kim with Lenders Lounge signing off. Thank you once again, Zach, for joining us today, and we'll see you on the next one.